Hello, and thank you for joining us for a recap of the first quarter and an update on what we're looking at heading into Q2. My name is Ryan Grady. I'm an investment advisor representative here at Paradigm, and I'm joined as always with our Chief Investment Officer, Dave Chenet. Just to set the stage, we came into 2022 with a defensive bias based on an estimation that the market had become too tech heavy and that the combination of rising inflation and rising interest rates would lead to a rotation from tech to some of the more forgotten areas of the market. Well, tech fell by 20% exactly through mid-March before staging a comeback to pare some of those losses into quarter end. So Dave, let's jump right in. What were some of the surprises in your mind from Q1?
Thanks, Ryan. We definitely lived through an interesting quarter. The main event, of course, is the invasion of Ukraine by Russian forces. But I'd like to highlight three economic forces that contributed just as much, if not more, to the broad losses that we saw in Q1. 1. Changed tone by the Fed. Coming into the year, the market was expecting the Fed to increase short-term borrowing costs by 1% throughout 2022. The Fed did raise rates by 25 basis points in March, but in light of tight employment and accelerating inflation, indicated that they would take more aggressive action to control inflation. Today, the market expects a total of 8 quarter-point hikes by the end of the year. Number 2, higher interest rates. While the Fed increased the short-term rates by 0.25%, longer-term rates jumped much more. The 2-year Treasury note increased from 0.18% to start the year to 2.35%. The 10-year Treasury rate jumped from 1.63% to 2.5%. The increase in rates led to one of the worst quarters ever for bonds. And number 3, increased volatility. We had 30 days in Q1 where the S&P moved by 1% or more in either direction, compared to only 17 days for the same period last year. We view this as an indication that we are in a late cycle market where fragility is still very high.
Awesome, Dave. I think it's easy to focus on the Russia-Ukraine headlines, but I think Dave's comments here reflect that the headlines are only a part of the story, and we need to always keep a close eye on the market fundamentals. So let's move on to Q2. Dave, has our outlook changed, or has our defensive outlook changed at all?
I'd say that we're still overall cautious. Keep in mind that market valuations are still extremely high, and we are in the very early stages of the removal of fiscal and monetary support that propelled markets to double their value from the March 2020 lows. We are, however, very selectively adding to some areas where we see opportunity. The two that I'd like to highlight are, first, reducing our exposure to commodities, which have been on a tear over the past year, to buy some US value-oriented names that sold off with the market as a whole, but we feel are much better insulated against a rising rate environment. And number 2, selectively adding to some European and emerging market names where the uncertainty surrounding the Russia-Ukraine conflict has been largely priced in already to markets. For longer-term portfolios, we see emerging markets trading at valuations that we haven't seen since late 2008. Looking back, that was a really hard time to buy those markets, but was also a very profitable time to buy those markets.
Wow, I think we packed a lot of information to just a few short minutes. So I'd like to take this opportunity to thank you all for your business, and we look forward to connecting with you as markets continue to evolve throughout the year.